You should think about what you want to buy, and then you can consider what to sell. It's more likely than not that you get like a 40% EPS rise on average for many years to come. That is a doubling. That is 100% return every second year. And in Mineros' case, you should really get that 100% already the first year, and then get around 40% per year. So another doubling every 2 years. You should think about what you want to buy, and then you can consider what to sell. That's the basic message. I've written a post about this a few months ago, detailing the logic behind it. You can think of it as exactly the same logic behind a hedge fund shorting stocks and a long-only fund buying stocks. Both profit from buying and selling stocks. They just do it in the reverse order. So a shorting hedge fund, it first borrows stock to sell short. They typically borrow it from a long-only fund. But never mind those details. The shorting hedge fund, it sells stock it really doesn't own, although it has to borrow it to have physical possession of it first. Anyway, they sell it on the market and hope for the stock to go down, or at least go down relative to some other asset they hold. And then when the time comes, they buy back those shares and return them to the ones they borrowed it from, to simply the share lender, usually a long-only fund, like a mutual fund, a pension fund. Of course, the mirror image of this is the long-only fund that is interested in buying Microsoft. So they buy Microsoft shares, and then when they feel that Microsoft has become too expensive or too large a weight in the portfolio compared to some other alternative, they sell those Microsoft shares, causing a slight downward pressure on the share price. That downward share price pressure is never recouped. So the long-only fund selling shares creates a downward pressure that never comes back, unless they sometime in the future decide to actually buy that particular stock again. So that's a true downward pressure on the stock price, in this case of Microsoft. But quite the contrary for the hedge fund that is shorting. They say that they are shorting Microsoft stock. They start by shorting Microsoft stock. So they borrow shares. Nothing happens when they borrow shares. Nobody's selling or buying anything. Then they short those shares, creating the same slight downward pressure on the stock price as would happen when a long-only fund sells their Microsoft shares. However, having shorted the stocks means that the hedge fund is forced to, they have to, it's absolutely obligatory to buy back those shares at a future date, even if it means losing money. And usually, in particular, it's when the share price is going up, has risen, especially quickly and in an uncontrolled manner, that the hedge fund feels forced to, or wants to, or simply decides to buy back those shorted shares. So when they buy back those shorted shares, they create an upward pressure. So it's quite asymmetrical, this, meaning that a hedge fund has a positive impact on a share price compared to a long-only fund that is selling shares. Just because once you have shorted it, you have to buy back the shares. So in total, of course, it's the same. It's just that the long-only fund bought the shares long ago. But once we are in the situation where all stocks are held by somebody, which they at all times are, then when there is a seller, they create a downward pressure that is not recouped. However, of course, it's the case that whenever anybody is buying or selling a share, there is a counterpart on the other side. So there is actually never a net selling pressure or a net buying pressure in that sense. What however is a fact is that sometimes share prices rise, sometimes they fall. When they fall, it's because people are the sellers are more eager to get out and get into something else. Possibly whatever they buy is from somebody else who's eager to sell, so they can get it. They get the shares pretty cheaply, and then themselves might, because of this generally bearish sentiment, to trigger themselves to yet again sell whatever they bought, being eager to sell to somebody else who thinks they are making a bargain at that low price, and then the price continues down. The same mechanism works on the upside. So you can never really say that they're never money on the sidelines, for example, of course, because all money is always held by somebody, and all stocks are always held by somebody. So that's not at all what happens. There are never money on the sidelines. There is never anybody particular causing a downward pressure that isn't countered by somebody causing an upward pressure. Then again, stocks can of course be wrongly, well, they can be mispriced. They can be too cheap or too expensive compared to their likely cash flows, but that is a completely different thing to discuss. Anyway, this discussion started somewhere completely different. So before I get back to that topic, let's consider the current state of oil prices. So we have the situation where the oil prices are going down, and that is usually a signal of a weak economy. One of the reasons they are going down is because OPEC has decided to print more oil. And I think that is simply a signal that OPEC, in this case Saudi Arabia, I think it was, they are not happy with high oil prices putting a damper on the economy, an economy that they see is getting weaker and weaker. And we see signals of that everywhere now. See, the Fed is discussing a bigger rate, a drop in their policy rates by probably 50 basis points in September, and then probably being forced to keep going. And it's and this weakness, whenever you get a weakness in the economy, especially in a highly leveraged economy, that can create long-lasting damage. And everybody wants to avoid that, especially politicians. That includes the Federal Reserve, that includes the US administration, and it includes, of course, the oil exporting countries that do not want to see demand destruction and weak links in the economy being permanently damaged, and thus making it sure and making it more difficult to come back to trend. So that's what we're seeing in the interest rate curve, which is showing a big dip in the middle of the curve, possibly pointing toward actually a zero interest rate policy in the US in the future, which at the moment sounds just completely bonkers when we are at 4.5%. In any case, what we started off discussing wasn't the weak economy and wasn't hedge funds shorting or the technicals behind that, but what it means to buy first and sell later. And it has all to do with eagerness and what's most important. And what I think is most important here is that buying first means that you're a bit more eager to buy stocks and assets that will benefit from the processes we are seeing in the economy. This weakening and oil printing, it points to possibly a Fed money printing and Fed quantitative easing, and what the fuck, and that means that gold will go up, Bitcoin will go up, shares that are already doing well will go up. And that means that all the trends that we've seen the last year, last half year, the last 10 years to 15 years is more likely to continue than suddenly being cut short. Buying first, selling later simply means try to rank your best ideas, your best buying ideas, And once you've pinpointed whatever it is that you really want to buy, where you're feeling a fear of missing out, that you see that this has a high risk-adjusted return, then you go ahead and buy that. Well, that of course means you have to have some dry powder ready, some liquidity ready, or a credit line, or you have to then turn your attention to whatever is the worst holding you have, whatever has the best combination of having poor prospects, share price wise, and high liquidity. So of course, if you have illiquid shares, you have to rank and decide between them which ones are the easiest to sell, not just best to sell return wise. So what you do is, for example, I think that Bitcoin treasury shares are the perfect vehicle to play this weakness and coming money printing. Next best is precious metals, gold and silver mainly. Try to stay away from commodities like oil and copper, because those are economy sensitive, economy dependent, meaning that if the weakening of the economy has a more negative effect, more deleterious effect than the potential revaluation upward from money printing. So in my ranking, I have the Bitcoin treasury companies and not the gold mining companies, where I've repeatedly said over the last few years that Mineros, Gold, and EMX royalty mining, that is, are my preferred vehicles to benefit from the precious metals positive trend. I'm coming to Mineros at this very moment. They released their earnings report very recently, and it was a really good report. Even though they had slightly surprisingly low average gold prices realized in their business, however, I think that was all due to risk management. They made so much money that early on in the quarter they must have sold their gold production at really the quarter low in order to get so low average gold prices. On the other hand, they showed tremendous cost discipline, actually being able to lower their all-in sustainable costs for gold production, and promises to keep lowering it. This is the hallmark of the new owners, Sun Valley and Vikram Sodhi, that they are really all about making mining profitable and a growth business. So on top of that, they are talking about expanding their business by using their $100 million, that is $100 million, $110 million cash, about $100 million net cash, give or take. Use that and of course some leverage as well to buy assets. And remember, the enterprise value of this company is just $480 million. So using, let's say, 100 million in cash and 140, 150 in debt, that would be 240 million in buying power on a company with an EV of 480. So you have a 50% buying power to add assets, and that is in a market where a lot of gold juniors are very lowly priced because they lack the cash, they lack this discipline, they lack net cash. So they are not in a position to buy, and that just makes the growth prospects all the better. And not only that, just a few days ago, after the finish of the second quarter, Mineros did buy a tremendous asset with gold finds. Sorry, I'm biking uphill here really strongly. So sorry for being out of breath. But they bought at just $40 million. They bought the remaining 80% of the La Pepa asset. La Pepa asset has more than 1 million measured ounces of gold and about 2.55 million ounces in total of measured, inferred, and sorry about that, I can't really breathe. Anyways, let's say 2.5 million ounces of gold potentially. Let's just calculate at $1,000 profit margin. That is 2.5 billion worth of assets bought at a total valuation for 100% of the assets of just $50 million. So it's a 50x. They're paying just 2% for gold in the ground. Absolutely, I know that's a bit of a hyperbole because you can't really count with all those 2.55 million ounces. But on the other hand, you have to somehow account for using not just $50 million, but $250 million, so 5x more for, well, actually 50 of those are already gone now, but at least 200 million. So 4x the buying power remains, and hopefully they can keep buying at these type of valuation, just thereby securing future growth, which is what is most interesting here, that you have a gold company that has that has strong growth prospects and growing at extremely low buying prices. And the one buying is this tremendous Sun Valley management that knows how to take a mine from a junior to a producer and do it cost effectively. And that we can get to the really interesting point here. And it's that, so how much do you have to pay for this super asset? Well, at the most recently reported Q2 earnings, actually, let's take it for the full half year, at the run rate they are at in earnings per share, and then adjust it for what the actual gold spot price is, which is about 10% higher than the realized average price for that half year, and they have an operational leverage provable by their all-in sustainable costs versus realized gold price of 2x. That means that they have already, at flat gold prices at 33.50, they have already secured a 20% increase in EPS. So that is their actual already established profit run rate, and at that run rate, they have more than $1 Canadian in earnings per share secured. More than $1 in earnings per share secured. That is their actual run rate right now, adjusted for the spot price of $33.50 per ounce. And the stock price, even after a quick run up lately, it sits at just 2.85 Canadian. So you're actually getting this legacy mine. It's 51 years old, highly cash flow, highly cash generative. They are paying more than a 5% dividend yield currently, just above 5, but slightly over. And they're also buying back shares at the rate of 2% per year. They have that mandate. So you're getting this and an earnings per share of over 1. You're getting this at 2.85 Canadian. So it's actually trading at just 2.5 times actual run rate earnings. They should be at least twice that, and I fully expect them to be at twice that in a year's time once you see the earnings materializing in exactly this way. And remember that on top of this, there is the potential of higher gold prices. And not just a potential, I think it's a very high likelihood of getting higher gold prices, which means that they are in effect trading way below 2.5 times earnings. So how is this even possible? Well, probably because there are so many small gold companies, and if you're not an insider, if you don't know Sun Valley and Vikram Sodhi, if you haven't followed his trajectory over the last 10 years or so that I have, because we have a mutual company called Gold Logic, where we also own Canagold and Mineros. If you haven't done that, then you can't it's hard to see the difference between all these hundreds of gold companies in Canada, not least. And then on top of this, in addition, you also have the fact, of course, that Mineros is mainly a Colombian gold mine, and even the new purchase La Pepa, it's in Chile. And you can never be fully sure what the governments will do in these countries when resource-rich companies become too profitable. So that is the risk. But you're getting. Just imagine that gold price keeps increasing by 10 or 15% per year, then you will get an earnings per share rise of 20 to 30% per year. And then if you add on acquisitions and subtract mine depletion, then you should probably add maybe another 10%. So it's more likely than not that you get like a 40% EPS rise on average for many years to come. That is a doubling. That is 100% return every second year. And in Mineros' case, you should really get that 100% already the first year, and then get around 40% per year. So another doubling every 2 years. So that is the Mineros case right here, right now on August 15, 2025. So it's that's the type of companies you want to find to create your own fear of missing out and knowing what to buy. But for somebody else, it might still be buying Nvidia or Meta or even the train wreck Tesla. I have no dog in that race, so to speak. But the important message here is to focus on the buying. That is what you do in the fall of 2025. And then you take a look at all your holdings and all your cash and whatever type of assets and loans, credit lines that you have. And you just consider which one can I most easily do without. And then you just sell that unsentimentally, because your alternative cost is your best buy ideas, which could be things like are promising 100% in the coming year, whereas your worst investments maybe only promise plus 10 to 20% or even minus 20%. What do I know what you own? Or for example, you need to pay 5 or 10% to borrow money to buy your best ideas. But anyway, that's what I mean with think about buying first and selling later, even if you in practice might need to, once you have identified your alternatives, you may have to actually sell first purely mechanically. So that's it for Karl-Mikael Siding for today, August 15, 2025.